Hi there, I'm Nick Moles, I'm from Wren Sterling, and this is a Q&A session with King and Shaxon for Money Matters magazine. We're here today because Wren Sterling's recently launched an ethical fund for our clients. Wayne Bishop is the Director of Investing for King and Shaxon. Thanks for joining us, Wayne. King and Shaxon have been around for a long time. They've been doing ethical investing since before Greta Thunberg was born. So Wayne, when you think back to when you guys started, what are some of the biggest changes you've noticed in ethical investing?
Well, way back in 2002, ethical investing was considered a domain of very negative investors, and you were expected to not perform as well as conventional investing, largely because real investors made the money by investing in everything. Now, of course, what's happened over time is that has moved not just from the negatives, i.e. what we're not going to invest in, but largely into a lot of the positives and the goods out there, the good sectors. Let's take renewable energy as one example. Renewable energy, back in 2002, it was just hydroelectricity. Wind was on the sort of cusp as a new technology. Maybe a wind turbine could power a few black and white television sets, and it would be very expensive. Today, wind is competitive with normal electricity. The offshore wind turbines are now sort of generating electricity at £39 a megawatt hour. They are very boring companies, producing a good amount of electricity, and therefore are a lot more investable. So from a fund management perspective, you have a lot more you can invest in. You have yield cos, you have conventional companies that weren't available 5-10 years ago. So the whole area has grown. So investment appetite has grown, and the investments you can choose have grown substantially.
So we're now in a place where investors are being confronted by terms like SRI, impact investing, ESG. You guys call yourselves ethical investors. How would you describe what that is?
It's a good question. Ethical is a very old word, and in fact I'd have to say a number of times we've thought, is it still the right word? But we always come back to the same conclusion. What ethical means is you just have a second screen. In other words, everyone knows when you make your investment decision you have a mandate and you have basically what you're going to do, your own investment criteria. All ethical does means is you're adding a second criteria. So what it means is that you're mixing your conventional investment process with a process that overlays a certain number of moral decisions, if you like. And so we like that term because that really describes what goes on. But underneath that term, if you like, you can call that the umbrella term. You have all these terms that you've mentioned. And I think what they do is they sort of produce what we know as a spectrum of capital. So at one end you have what we call responsible investing. What does that mean? That means it has one of the lightest green approaches. That means that the ethical considerations will be relatively minor, and what it will mean is we will exclude perhaps the most evil of companies. So we will exclude tobacco, we will exclude armament companies, we may exclude fossil fuels, or we will have just the better fossil fuel companies, something like that. So what you have here is the very light green end of the market. You then have things like ESG and SRI, that's environmental, social and governance, or socially responsible investing. What they will do is they will add in a little bit more. So they'll say we want to see a slightly greener approach. We want to see considerations taken to how well they do the business, to their conduct, and we want to see them sort of integrating these policies into what they do. So if you like, that's taken a little bit more of the middle ground. And then we move into what we call positive investing, and that is we want to invest in things that do good. And at the very end of that, we have something called impact investing, where the fund managers and the funds will be aiming to specifically hit some of the social development goals that the United Nations have set out, or all of them. So the investments will have a focus on doing something good. So you have this whole spectrum of capital underneath the ethical label, and we specialise in really covering that whole umbrella.
So as a consumer, I've noticed an appetite, almost an awareness of the types of factors you've described increasing in society. I think for Wren Sterling, we've been looking at this for a couple of years now, and that sort of coincided with David Attenborough's plastic documentary, which was huge and took it mainstream. Is there a moment for you that you can think of that really turned the dial and interest in ethical investing?
Yes, I'd say over the last 3 or 4 years we have seen a real substantial rise in interest. And I will put it down to 2 or 3 factors. But you're right, the Attenborough film absolutely overnight changed people's attitudes towards plastic. But let's go back a little bit. What is really turning the dial? I would say number 1, it is generational change. And by this I don't mean the millennials, I actually mean Generation X. These are the people who are in their early 50s down to their sort of late 30s. And these people are the people who are getting economic power, i.e. they're inheriting money, they're now earning good money, their children are no longer a cost, and there's therefore saving a lot more money. These are guys who, like me, grew up with Sting in the Rainforest, with anti-apartheid movements going on, and with people worried then what we called the ozone layer. And all these kinds of considerations were important to them. These are the people who are really pushing the dial. And of course, these are the people with their kids who are generally millennials, and their kids will be the Gretas of this world, who are very passionate about it. So you have the parents who understand it and have the kids who are passionate, and you have the parents who are seeing that their kids are going to have to face the consequences of some of these ecological problems and some of these social problems. So I think altogether, we're seeing these factors come together with the fact that the whole sector is now much more mature and much more investable. There's a lot more products out there for people. There's a lot more mature investments, and it's all coming together into what I would call a perfect storm. Add to that the good performance track record that we're beginning to see, which I know we'll touch on later. I think this is the big moment that we're now seeing, and I can really see this sector rising from being anywhere between, say, 2 or 3% of global AUM to being 10, 20% of global AUM. Without global AUM actually changing, more and more people are going to want to see this.
So you mentioned that there's more performance data in the market now. How important do you think data is for continually proving the concept and convincing people to look at ethical investing?
I think it is really helping, and it is very important. So, as I mentioned, back in 2002, you were considered perhaps the weirdo in the room, and you were obviously considered not to be the investment for real men, if you like, or real women. You know, this was sort of a fad or a fashion-led investment. Increasingly, the data, and particularly if you look at the last 5 years, has shown that ethical investing or ESG investing has continued to outperform. And even actually in 2020 to date, with the markets dropping as they are, I had a look at some of the data yesterday. We're still in about roughly a 1% outperformance in ESG, even in 2020. And this is happening for a number of reasons, and I think it will be good to say, and nice to say, that it's happening because ethical companies or ESG companies are obviously better companies and will perform better, and I do believe there is some truth to that. But I also think one of the biggest factors is that the big difference is that ESG funds tend to be underweight sectors such as mining, oil and gas in particular, and a lot of the other commodities. And of course, these commodities are what adds volatility to the market. And for the last 5 years, they've tended to be a bit of a weight, i.e. dragging performance down rather than driving performance. So that has certainly also helped the case. Now, of course, if they suddenly shot up, we might see some of the less ethical funds or the non-ESG funds suddenly start to do very well again compared to the market. But I don't necessarily see that case in the long-term future, but I think investors need to be aware that that has played a big role in the performance.
And Wayne, can you think of an example when investor behaviour has changed either the world or a particular organisation and how that's fed through into ethical investing?
Yes, I think there was a very early example going back to sort of the beginning of the sort of century, really, with a company called Peacock, which was, of course, a well-known clothes retailer, or still is a well-known clothes retailer. Back then, they were approached and sort of pressure was put on them to make sure they had very good ethical practices in the way they sourced their clothes, etc. And they did it. And they were one of the leading or one of the best clothes retailers until they were taken private in 2005. So there you saw a clear example of investor pressure driving a company to have good standards. I generally have to say I'm a little bit sceptical about some of the engagement arguments. I think quite often they're used as an example of investors changing things, but actually it's not just investors, it is often a number of other factors all at the same time converging with investors. Go back 2 or 3 years ago, we had the big issue about boardroom pay, and where there was perhaps a victory for shareholders with Aviva. We, along with other shareholders, voted against the pay package for Andrew Moss and the board, which led to some big changes. And there was an example of a victory, if you like, for shareholders. But at the same time, there were a number of other cases where people were voting against it in large numbers, and the boards carried on regardless. So you can see there is a marginal success there. So you need to see other factors as well as just investors working, and sadly that has not really continued. It happened for 1 or 2 years, and then really, we don't hear about it anymore. So I'm a little bit sceptical about the whole engagement, but there are cases where I see particularly ethical companies make a difference, and I'll point out here Cafe Direct. Cafe Direct was a pioneer in fair trade. When they started, fair trade was not considered in any way viable. It was considered a bad idea, but they successfully managed to market fair trade tea and coffee, and people were buying it. Cafe Direct products were on the shelves in supermarkets. Sadly, what then happened is that everybody else went fair trade, not to the same degree as Cafe Direct, and in fact, various people will have opinions about some of the fair trade operations out there now, but what you saw was that all the supermarket owned labels started offering fair trade, everybody else started offering fair trade. So you saw a change in behaviour because there was an improvement in the pricing mechanism and in the behaviour of people and what they paid farmers, but sadly that crowded out Cafe Direct to a large extent because everybody else had their own products and people went for them. But what you saw there was somebody pioneer and make a change that nobody thought was possible, and I think that is to the credit of Cafe Direct.
So as an investor, if we invest through King & Shaxon, how do you guys make sure the companies you invest in are conforming to the standards that you set?
Good question. I think probably just to reassure you at this stage, our investment process is based on 2 things: having good sound financial investments and good sound ethical investments. So our ethical investment process starts with a lot of the basic financials. So we'll be looking at exactly the same things as anyone else. So what is the asset allocation? Are we, how much are we putting at risk in equities? How much are we putting into bonds, etc.? What kind of bonds we're investing in terms of the quality and how their duration, perhaps on interest rates. The companies, whether they're large companies, small companies, geographically diversified, product diversified. We look at all of those things. But then when we start to really want to look at a company, we will look at it with 2 eyes. We'll do a quantitative ethical screen and a qualitative ethical screen. The quantitative side will be taking the hard data from data providers, get an 80-page report that will take us through all of the ESG profile of a company. It will have the ESG scores of the company. It will have all the controversies they're involved in. So we will look through all that hard data. So it will be things like the carbon footprint, the water stress, the sort of gender pay gap, any striking and social issues, board attendance, bad shareholders, all of those kinds of things will be looked at and very quantitatively. But then we have to look at the qualitative side too, and that is it still what investors want? Because a lot of companies can get a very good ESG score and still be doing something bad. And we don't want to sort of see those companies included. We don't want to be shoehorning companies in saying, well, they're reasonably ethical. We don't want to say, oh, well, BP are going to be carbon neutral when the product they make is not carbon neutral. There's nothing carbon neutral about oil at the end of the day. Or fossil fuels. So we're not going to be trying to justify things on an ESG basis. We have to still make sure we're hitting the qualitative side as well, i.e. is this what investors want? Because at the end of the day, we want the investors to be happy that we have looked at both sides, the investment side and the ethical side.
There seems to be a consensus building towards companies operating in the right way. At what point do you think all investing will become ethical to some degree?
I think there's going to be a needle shift, if you like, where ethical standards are going to rise. A little bit like we're seeing with the senior management regime in our business, where now the expectations on the boards are much higher. in the way that companies conduct themselves. So that pressure, I think, is going to exist on all companies. So yes, we are going to see companies behave a lot more responsibly towards the environment. We're seeing that come through in some of the stakeholder groups in America, some of the promises people are making to change the way capitalism works, because I think society expects that. So in other words, companies will no longer just consider the shareholder, they will have to consider other factors as well. And because the data is out there, it's very difficult now for some people to hide bad tax practices, for example, or bad governance practices. So there will be a general improvement, I believe, across the board. But I think there's also still going to be a great deal of temptation for people to tick box, and there may just be a lot more boxes to tick, but at the end of the day, a lot of people are just going to tick the box or do what they do. It's kind of like those people who will have just some token females on the board to make the board look right, or whether they are genuinely there to genuinely saying we want to be a company that gives every person and anybody, regardless of their gender, a fair chance.
So in a sense, it's down to the likes of you to keep sort of changing the way that you analyse companies to make sure that people aren't, you know, like you say, ticking the boxes and conforming to what's there.
Yes, exactly. I think we still like to know that the companies are genuine about the change they want to do. And even when we look at funds, that the fund management houses, that it's not being done just as a job by the fund manager, but there are people there who are genuinely passionate about what they do. And we see the difference in the number of groups where you know that actually this is a genuine interest and not just do this fund for a couple of years and we might let you on another fund kind of thing. This to us is very important, that there is a genuine passion and that the investments are really focusing on the right things. So we said we're not going to shoehorn investors, we're not going to say, oh, they're nearly ethical or they're doing something well, and we're not going to be taken in by the greenwash. Every company produces an SRI report or a social governance report. They all pretty much look the same, if I'm honest, and they all say good things. Of course they do. But at the end of the day, we want to know this is actually something that is core to what they do, or that they really are out there doing something that is changing the dial for the world, and not just for themselves. So yes, it does mean you have to sort of look a little bit deeper than just the reports, and you have to keep your finger on the pulse. Things change, fashions change, and this isn't so much what I would call a fashion-led industry, but issues that matter to people do change. You mentioned David Attenborough earlier. I mean, overnight, people's attitudes to plastics changed. Overnight, we saw various groups that have been heavy users of plastics, say supermarkets, all come out at different paces saying this is how we're going to address the issue. And you see the more ethical ones, again, being the ones who are saying we're going to be faster, we're going to cut deeper, and we're going to really sort of seek to just get plastics out of the system. It's easy to blame them for the problem, but back in the 1980s, I remember plastic was the wonder thing. It was making everything cheap and everything clean, and it was just solving so many problems. And of course, it's only recently that we've suddenly become aware of, look at the problems we've created by it. So it's how people respond, and I think that to us is their default, and that to us tells us a great deal about a company. If they've got a good default, they see a problem, and they say, we are going to respond to this problem, that to us are some of the things that mark out the better companies.